Welcome back to the Zero Fluff Books Podcast. I'm Lauren, and today we're going to talk about something that sounds technical but is actually one of the simplest, most powerful tools you can use to keep your books clean: your chart of accounts. Now, before you roll your eyes and think, that sounds like accountant jargon, I don't need to worry about that, let me stop you right there. Because here's the truth: your chart of accounts isn't just for accountants, it's for you. It's the foundation of your bookkeeping system, and it's what makes your numbers actually mean something. Let me give you a picture. Imagine two business owners. The first logs every single purchase under one big bucket called miscellaneous. At the end of the month, she looks at her books and sees $2,000 in expenses. That's it, just one big tangled pile of numbers. The second business owner has her expenses broken down into clear categories: $500 for supplies, $700 for shipping, $800 for tools. At the end of the month, she doesn't just know she spent $2,000, she knows exactly where it went. Now, who do you think has more control over their business? That's the power of a chart of accounts. It turns spaghetti into structure, it takes a mess of numbers and organizes them into a system you can actually use. So, what is it really? A chart of accounts, sometimes called a COA, is simply a master list of categories for your money. It's the list that tells you where income goes, where expenses goes, what buckets your numbers live in. Think of it as the map key for your bookkeeping. Without it, your numbers are just dots on a page. With it, they make sense. And the best part, you don't need a complicated system. You don't need 50 categories. You just need a simple, clean list that fits your business. Now you might be thinking, do I really need this if my business is small? Yes, you do. In fact, the smaller your business, the more important it is. Because when your margins are tight, every dollar matters. If you lump everything together, you'll never know if you're overspending on supplies, undercharging for shipping, or leaking money on subscriptions you don't use. Your chart of accounts gives you visibility. It shows you the patterns, and it gives you the power to make changes before small problems become big ones. For an Etsy seller, that might mean separating materials from shipping supplies, so you can see how much packaging is really eating into your profits. For a tradesperson, that might mean separating tools from vehicle expenses, so you know what it really costs to run your jobs. Without categories, you're guessing. With them, you're in control. Let's imagine a seller named Lisa. Lisa makes jewelry on Etsy. She brings in a few $100s a month, and she keeps her books in a notebook. Every expense, silver wire, beads, shipping, even website hosting, she just writes down under expenses. At the end of the year, she tallies it up. Expenses, $4,000. But here's the problem: Lisa has no idea where that money went. Was it mostly materials? Shipping? Ads? Without categories, it's just a blur. Now imagine if Lisa had a chart of accounts. She could see she spent $2,000 on materials, $1,000 on shipping, and $1,000 on ads. Suddenly, she knows where her money is going. Suddenly, she has choices. She can cut back on ads, look into cheaper shipping options, or raise prices to cover her material cost. That's the difference. Without categories, she has numbers. With categories, she has clarity. So why do so many small business owners skip creating a chart of accounts? Because it sounds intimidating. It sounds like something that belongs in QuickBooks or with a CPA. It sounds like paperwork. But here's the secret: it doesn't have to be complicated. You can create a chart of accounts on a single sheet of paper, in a spreadsheet, or in a notebook. You can keep it as simple as 10 categories: sales, materials, shipping supplies, tools, advertising, software, office expenses, vehicle expenses, bank fees, miscellaneous. That's it. 10 categories, and suddenly every transaction in your business has a home. So here's what we're going to do today. First, we'll talk about why the chart of accounts matters, how it turns messy numbers into useful information. Then we'll walk through how to build your own chart of accounts, starting small, keeping it simple, and making it fit your business. After that, we'll cover common mistakes, like overcategorizing, undercategorizing, and dumping everything into miscellaneous. And finally, we'll wrap up with a recap and a simple action step you can take today to create your own chart of accounts. By the end of this episode, you'll see that the chart of accounts isn't scary. It's simple, it's practical, and it's the secret weapon to turning your books from chaos into clarity. So if you've ever looked at your expenses and thought, I know I spent money, but I have no idea where it went, this episode is for you. Alright, so now that we've cleared up what a chart of accounts actually is, let's dig into why it matters so much. Because here's the thing, without categories, your numbers are just noise. They don't tell you a story, they don't give you insight, and they don't help you make better decisions. But once you put structure around them, once you give every dollar a category, suddenly your books stop being spaghetti and start being a map. A map you can actually use to guide your business. Picture this, you log into your bank account at the end of the month and see $2,000 worth of expenses. That's all your statement tells you. Money went out. Now, what does the number really mean? Did you spend $2,000 on materials, tools, gas, ads? Nobody knows, not even you. That's the problem with leaving everything lumped together. The number exists, but it's meaningless. It doesn't help you cut costs, it doesn't help you price smarter, and it doesn't help you plan. Now let's contrast that with the same $2,000 broken down into categories. $500 supplies, $700 shipping, $800 tools. That's a story. That tells you where your money is going. That gives you insight you can act on. Big companies rely on charts of accounts to manage their complexity. But here's the secret. For small businesses, it's even more important. Why? Because your margins are tighter. You don't have room to be sloppy. If you're an Etsy seller, knowing that you spent $200 on packaging last month might push you to order in bulk to save money. If you're a tradesperson, knowing you spent $1,000 on fuel might encourage you to adjust your pricing or route jobs differently. Without categories, you're blind. With categories, you can see what's eating your profits and take action. One of the biggest stresses I hear from small business owners is this: I never know if I'm making money. That's not really a profit problem, it's a clarity problem. If you don't know where your money is going, you'll always feel uncertain. You'll always feel like you're guessing. But the minute you organize your books with a chart of accounts, that stress starts to disappear. You can see exactly how much you made, where you spent, and what's left. You stop guessing and you start knowing. And that confidence, it changes everything. It helps you price better, spend smarter, and sleep easier. Let's also be practical here. Categories matter at tax time. If you've ever scrambled through receipts in March trying to figure out what was supplies and what was shipping, you know the pain. But if you've been tracking with categories all year, your numbers are ready. You can hand over clean totals instead of a shoebox full of chaos. And while I'm not giving tax advice here, I'll just say this. The IRS doesn't accept miscellaneous as an explanation for your expenses. They want categories, and the cleaner your categories, the smoother your life will be. Think about it this way. Your chart of accounts is like the dashboard of your car. Without it, you're driving blind. You know you're burning gas, but you don't know how much or where it's going. With it, you've got gauges, you can see your speed, your fuel, your mileage, and with that information, you can make better choices. Your business works the same way. Categories turn random numbers into gauges you can actually read. If advertising is climbing, maybe you need to review what you're spending. If shipping is eating too much, maybe it's time to look into other shipping options. If supplies are high, maybe you need to raise your prices. But you can only see those signals if you've got categories in place. Let's imagine two shop owners, Ava and Mark. Ava doesn't use a chart of accounts. At the end of the year, her book showed $10,000 in expenses. That's all she knows. Mark, on the other hand, uses a chart of accounts. His books show $4,000 supplies, $2,000 shipping, $3,000 tools, $1,000 advertising. Both of them spent $10,000. Both of them spent $10,000. But Mark knows exactly where it went. He sees that tools are a major cost, while Ava is left guessing. Who do you think can make better decisions? Who can cut, adjust, and plan with confidence? That's the power of categories. So here's the takeaway. A chart of accounts isn't just an accounting formality. It's the backbone of your bookkeeping. It turns noise into clarity. It turns stress into confidence. It turns random spending into patterns you can actually use. For side hustlers, Etsy sellers, and tradespeople, That clarity is priceless because when every dollar matters, you can't afford to lump your numbers into miscellaneous and hope for the best. In the next section, we're going to talk about how to build your own chart of accounts. I'll show you how to start simple, keep it practical, and create categories that make sense for your business without overcomplicating it. Alright, so now that we've covered why the chart of accounts matters, let's get practical. How do you actually build one for your business? Here's the good news. You don't need to reinvent the wheel. You don't need 50 categories to get started. In fact, the simpler you make it, the more likely you are to actually use it. Step 1. Start with 3 main buckets. Every chart of accounts, no matter how big or small, comes down to 3 big buckets. 1. Income, all the money coming in. 2. Cost of goods sold, or COGS, the direct cost of making or delivering what you sell. And 3. Expenses, the cost of running your business. That's it. 3 buckets. Everything else lives under them. Step 2. Define income. For most small businesses, income is pretty straightforward, but it's still worth breaking it down a little. Sales. This is the main category for everything you sell, products, services, or both. Refunds or returns. It's helpful to track refunds separately so you know how much you've had to give back. For example, if you made $1,000 in sales and refunded $50, your book should show both. That way, you can see that refunds took 5% of your revenue that month. Step 3. Define cost of goods sold, or COGS. This is where you track the direct cost of producing what you sell. Think of it as the stuff you wouldn't spend money on if you weren't making your product or delivering your service. For an Etsy seller, that might be materials such as fabric, beads, wood, paint, packaging such as boxes, envelopes, or labels, and shipping supplies. For a tradesperson, it might be parts or supplies for each job, direct labor if you hire someone to help on a project, or job-specific tools you buy just for that contract. COGS is important because it helps you calculate gross profit. Sales minus COGS. That number tells you how profitable your product or service is before overhead. Step 4. Define expenses. This is where most of your categories will live. Expenses are everything else you pay to keep the business running. Here are some common categories for side hustlers, online shops, and trades. Advertising or marketing, such as Etsy ads, Facebook ads, business cards, flyers. Software subscriptions, Canva, website hosting, inventory apps. Office supplies, papers, pens, notebooks, printer ink. Tools and equipment, hammers, sewing machines, computers. Vehicle expenses, gas, maintenance, mileage tracking. Bank and payment fees, PayPal, Stripe, Shopify, or Etsy fees. Utilities, internet, phone bill, or electricity, if used for the business. And miscellaneous, for those few things that don't fit anywhere else, but keep this category small. You don't need to list every possible expense type. Start with 10 to 12 categories you know you'll actually use, or better yet, just pull up the Schedule C from the IRS and use those categories as a guide. Step 5. Write it down. Your chart of accounts doesn't have to live in fancy software. It can be a page in your notebook, a tab in your spreadsheet, a simple one-pager pinned above your desk. The point is to create a reference list you can always check. Every time you record a transaction, you look at your chart and ask, which bucket does this belong in? Step 6. Keep it consistent. Here's the key. Once you pick your categories, stick with them. If you decide shipping supplies belong under COGS, always put them there. Don't bounce between categories from month to month. Consistency is what makes your reports meaningful. Because at the end of the year, you don't want just a list of numbers. You want patterns. You want to know what's rising, what's falling, and where you might need to adjust. You only get that if you use categories consistently. Step 7. Adjust as you grow. Your first chart of accounts doesn't have to be permanent. As your business grows, you can add categories. For example, if you start hiring help, you might add contract labor. If you launch a second sales channel, you might add Amazon sales or Shopify sales. If you start shipping internationally, you might add customer import fees. The key is to keep it lean at the beginning. Start simple, then add detail as your business needs it. So here's the bottom line. Building your chart of accounts is about creating structure. 3 main buckets: income, cost of goods sold, expenses. A handful of clear categories in each bucket, and a system you can actually stick to. Don't overcomplicate it. Don't create 50 categories you'll never use. Start small, be consistent, and let your chart of accounts grow with your business. In the next section, we're going to cover common mistakes people make with their chart of accounts and how you can avoid them from the start. Because a simple system is powerful, but only if you use it the right way. Alright, so we've talked about what a chart of accounts is, why it matters, and how to build one. But before you dive in, let's cover something just as important: the mistakes to avoid. Because here's the truth: your chart of accounts can be your best friend or your biggest headache. It all depends on how you set it up and use it. Mistake number 1: over-categorizing. This is the most common trap I see. A new business owner sits down to create a chart of accounts and thinks, the more detail, the better. So they create 50 different categories: printer paper, pens, staples, highlighters, and so on. What happens? Recording every transaction becomes a nightmare. You spend more time debating which category to use than actually running your business. The fix? Keep it lean. 10 to 12 expense categories is plenty for most small businesses. Think in terms of big buckets, not tiny details. You can always add more later if your business grows. Mistake number 2: undercategorizing. On the flip side, some people go too simple. They create 2 categories: income and expenses. Sure, it keeps things easy, but it also keeps things meaningless. You'll never know if your expenses are being eaten up by advertising, shipping, or tools. It's just one big blob. The fix? Break expenses into logical groups: supplies, tools, shipping, advertising, software, vehicle expenses. Enough detail to give you clarity, but not so much that it overwhelms you. Mistake number 3: dumping everything into miscellaneous. The dreaded miscellaneous category. Now, don't get me wrong. It's okay to have a few miscellaneous buckets for the odd expense that doesn't fit anywhere else, but too many businesses rely on it as a catch-all. The problem? If half your expenses live in the miscellaneous bucket, you've lost the very clarity your chart of accounts is supposed to give you. The fix? Use miscellaneous sparingly. If you find yourself putting the same kind of expense in there more than once or twice, it's time to create a real category for it. Mistake number 4: mixing personal and business. This is a big one. If you swipe your business debit card for groceries or use your personal card for supplies, you'll muddy your categories and create confusion. Remember, your chart of accounts only works if your money is separated. If personal expenses sneak in, your categories become meaningless. The fix? Draw a hard line. Business account for business, personal account for personal. If you accidentally mix, record it properly as an owner's draw or personal contribution, but don't let it become a habit. Mistake number 5: not updating as you grow. Your business will evolve, and so should your chart of accounts. If you started with 10 categories and now you're selling on 3 platforms, hiring contractors, and running ads, you may need to add new buckets. The mistake is sticking with your original chart forever, even when it no longer fits. The fix? Review your chart of accounts once a year. Ask yourself, do these categories still make sense? Am I lumping too many expenses into one bucket? Has my business outgrown this structure? Adjust as needed, but keep the core simple. Mistake number 6: inconsistent use. Here's a sneaky one: inconsistency. Let's say one month you record shipping supplies under supplies, and the next month you record them under shipping. Now your year-to-date report is useless because the numbers are split between 2 places. The fix? Pick a home for each type of expense and stick with it. Consistency is more important than perfection. Mistake number 7: copying without thinking. It's tempting to grab a chart of accounts template off the internet and call it good. But here's the problem: Most of those templates are designed for big companies, not side hustlers or small shops. You'll end up with categories you'll never use, like amortization or shareholder distributions, cluttering up your system. The fix: customize. Start with a template if you want, but strip it down. Only keep the categories that make sense for your business. So here's the big takeaway: your chart of accounts is only as useful as you make it. Don't overcategorize and drown in detail. Don't undercategorize and lose clarity. Keep miscellaneous small. Never mix personal with business. Update as your business grows. Be consistent. And don't just copy a template. Make it your own. If you can avoid these pitfalls, your chart of accounts will be the backbone of your bookkeeping. It'll give you clarity instead of confusion, confidence instead of chaos. In the final section of this episode, we'll do a quick recap and I'll give you one simple action step to get your chart of accounts started this week. Alright, let's bring this episode to a close. We started by clearing up what a chart of accounts actually is. Not accountant jargon, not something only big companies need. It's simply the list of categories where your money lives. Think of it as the map key for your bookkeeping system. Then we talked about why it matters. Without categories, your numbers are just noise. With categories, you can see patterns, make decisions, and feel confident instead of guessing. From there, we built a practical chart together. 3 main buckets: income, cost of goods sold, and expenses. A handful of categories under each that fit your business. Simple, consistent, and flexible. And finally, we walked through the mistakes to avoid: overcategorizing, undercategorizing, leaning too hard on miscellaneous, mixing personal and business, or copying templates that don't fit your world. The big idea: your chart of accounts doesn't have to be complicated. It just has to be clear, consistent, and useful to you. So here's your action step this week. Write down your first chart of accounts. 10 to 12 categories are plenty. Put them in a notebook, a spreadsheet, or pin them above your desk. Then commit to using them every time you record a transaction. The more consistent you are, the more powerful your books will become. And here's what's coming up next in episode 7. We're going to dig into reconciliation. I'll show you how to match your books to your bank account without stress, and why this one habit is the secret weapon for catching mistakes early. Until then, remember, clean books equal less stress. Thanks for listening, and I'll see you next time on the Zero Fluff Books Podcast.